everyone. Welcome to another interesting tool that I'm about to share. So let me ask you this question. You do all the research and you want to purchase a stock, but you are really confused whether the valuations are attractive or not. You're not able to come to a judgment as to what is the stock actually worth currently. And the most important question in investing is purchase price. It can do wonders to your portfolio, and if you pay something which is expensive and the stock falls, it can have a negative effect on your portfolio, and it is much more prominent for micro cap and small cap. And that is where this tool gives you an intuitive idea as to come to a conclusion whether the current price is reasonable or not. And it's a very simple tool, and I am sure everyone uses Screener. All you have to do is install a Google Chrome plugin. The name of the tool is Smart Analyzer, and it would give you wonder in terms of valuation. I use it a lot. It gives me a clarity, bird's eye view clarity. Blindly trust the tool, but it gives you a bird's eye view clarity as to where the current price is and if the stock is attractive at the current level or not. And before we start the video, I would suggest you to check out my video on the 20 point scorecard. If you're finding it difficult to come up with a framework to screen a stock or shortlist a stock, this is a wonderful tool that I use personally to give an idea as to whether to do a deeper research when it comes to investing in a company. If you have not checked, please do check. So now let me take you through the tool, the Smart Analyzer tool. It's a wonderful tool. It's a Google plugin, so I have already installed it. Have to install it. All you have to do is go to the Chrome extension and select the Chrome store and just type in Smart Analyzer. Just type in Smart Analyzer. See, it automatically comes in, and just add it to the Chrome. They have given you a YouTube video explainer as well, which you could watch, but my focus of this video is to show you, the type of companies and the valuation in general and how to think about it. Before we deep dive, quick note, we are opening Early Edge Club to a small founding cohort of 15 to 20 serious microcap investors. We are building a research first community where we break down businesses together. Every month, we vote as a group and go and deep dive into 2 microcap stock chosen by the community. You will be surrounded by thoughtful, like-minded investors from diverse backgrounds, and we are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form in the description and we will reach out to you soon. So for this, I've selected 5 different companies because this tool is not suitable for all type of companies, and I'll tell you can actually use. The first company we're going to use is on a larger company. I've selected Asian Paints for multiple reasons. It was darling of the street, competition heated up, and the valuations were expensive, and still a cash generating machine, steady compounder. Let's see at the current PE of 57 whether it makes sense investing at the current price, and follow through so that you get an idea as to when it comes to investing what parameters to look into and how to think about the whole process. So if you look at the historical PE, the price has corrected from around 3000 level, and over the last 5 years, 10 years, the average PE is around 60. So it is below the median, below the average PE of 60. So all I did is I clicked on Smart Analyzer. There are lots of interesting features they have. If you are someone who follows common size, if you click on common size, it gives you this wonderful common size trend, which you could see to look at where the cost inflation is happening or where the trend is, changing from the historical levels. So look at how it has wonderfully captured the best case and the worst case in terms of the next 1 year earning or the trailing 12 months earning. So all it does is it takes historical average growth rates and the best historical average growth rate to calculate the best case and the worst case. And again, it takes average value everywhere. So this is not again something which you have to know the company in depth to understand what the moving parts, and take this as a tool to give you a second layer of validation when it comes to the price and where the company stands in terms of valuations. So currently, as you can see, the margins have fallen because of the competition, and if you feel and it has taken the best case in terms of historical operating power margins, and given at 19.5, good thing about it is you can actually play around with the numbers. 19.5 looks like doable, and it has again taken historical price to earning range. But if you believe 50 PE, it's always better to key in conservative numbers so that you have margin of safety when it comes to the valuations. And if you see, you can see that the price automatically adjusts and give you a 1 year forward price target. It's a very good tool to give you an intuitive idea as to what a 1 year forward price target can be. Listen to the con calls and make these judgments when you're playing with the margin numbers. Management generally give guidances to it. So this is one amazing thing. So current price is 2,370, and based on this estimate, on the best case scenario, it's giving 2,620. So some upside, but worst case, it is fully priced in. I'm a long-term investor. More than this tool, I like the tool which I'm going to show. It is the reverse DCF. So I'll tell you what parameters to key in. Basically, this earnings is free cash flow for Asian Paints. It's a cash generating machine, so you have good free cash flow to take free cash flow as it is. And generally free cash flow is taken from profit before tax, or the numbers are like you could see the conversion happening between the profits and the free cash flow, very close numbers. So I would generally, for a larger company, for a stable company, I would generally take the same free cash flow levels for my calculations. And this discount rate is the rate or the minimum return you expect from the investment. Bank is giving 7%, so your minimum return, bear case, should be 10%. I would want higher return, but then at least 10% should be the return you would want from any stock that you are investing in. Terminal growth rate is what the company would grow after the number of years you're keying in here, like on a conservative basis. For example, if you are looking for an investment for 5 years, and this terminal growth rate tells you like after 5 years, the company would consistently grow at 2% a year. Don't key in a very high number because it will distort the calculation. Be conservative when you're using these figures. And I would give a lower PE multiple of 50. You could give an average, but again, it also tells you the current multiple. The current multiple is 87. And here it's better to be conservative. And if you calculate, it gives you a number. So what it does is, for you to realize a return of 10%, and if after 5 years, the PE, Asian Paints PE is 50, it means Asian Paints has to grow year on year at 20.6% for you to realize at least 10% return. And listening to management con call and interesting insight, you can come to a conclusion whether this 20% implied growth rate is achievable by Asian Paints for you to realize at least 10% return. It makes your life simple. Analyze the company, know what its triggers are, what its future growth rates can be, and it gives you an idea as to whether it is doable or not. Again, these are based on the numbers you are keying in here, and it can vary drastically. For example, if your holding period is 10%, the company has to grow only at 15% year on year. So you can see how small changes in value can have a lot of changes in the implied growth rate. If you think it is going to be worth 60 PE at the end of 10 years, the implied growth rate automatically drops. So let me take you through to another example. Now that you understand how the tool is, let's try out with different companies. I'm going to select a hot sector of 2025, which is defense. And one of the company I really like is Solar Industries. And let us see whether at the current valuation, if it makes sense to enter Solar Industries or not. Already trading at a 124 PE. And the historical, if you see the historical 10-year average PE is around 45, I would say, and it's at 125 for different reasons. But are you comfortable? What is the margin of safety is the question that you need to ask at every level. So automatically, I would really love if I could edit at least the revenue numbers, this tool, but it automatically calculates the best case and worst case revenue based on the historical figures, and also calculates the average operating margin. And listening to the con call, you need to come to a conclusion whether this revenue is achievable or not. If it is overshooting this number, I would suggest you to play around with operating margin, reduce it a bit so that you get an idea as to what the target price can be. And based on that, this is a huge variation, right? Like, I mean, based on this, I think the best case 90 PE, it's already factoring in like 1 year forward price target of 15,600 rupees. It's trading at 17,000. I mean, based on this, we could come to a conclusion that a lot of things are already factored in. But again, listen to the con call. If they say they're going to double from here, then this price looks cheap. So always read the con call, listen to management, what they are saying, and try to come to a conclusion based on the facts that are available. Correct. And look at what small changes. If you think the margins are going to be 27%, see the price has changed from 15 to 16,621. So small changes in margins can also have a magnifying effect on the price, similarly to with the P. Again, when it comes to free cash flow, here look at the kind of investments they have done in terms of, investing activity. If you take Asian Paints, they are not investing much. They don't have to invest much. So the cash from investing activity is not much. So the free cash flows are higher. But with solar, they are investing aggressively. And that is one of the reasons why you can see that it is trading at a higher PE, because they are investing for the future. With solar industries, if you are taking higher risk, and I would at least require a return of 15% with this company. The terminal growth rate I would put anywhere between 2 and 3. Please play with your numbers, and 5 years is your time horizon, and 50 PE multiple is what you're comfortable with. It gives you that solar industry has to grow by at least 30% for the next 5 years for you to realize 15% return with a terminal multiple of 50 PE. Yeah, very quickly you are able to come to a judgment as to what factors you need to look into and understand if the current price is reasonable or not, and if there is margin of safety. With cyclical, it becomes a little more trickier. I'm going to show you example of Aarti Industries. We all know chemical cyclical gone through phase of deep correction. This is the price chart of Aarti Industry. If you take PE, it's at 53 PE, but again, a lot of this is because the margins are compressed, right? And which is factoring to an inflated PE, and the market is expecting margins to go back to its mean, and that's why it's trading at higher PE. So make that judgment call. So after running the tool, you could see revenue automatically captures the historical best case growth rate and the worst case growth rate, and look at the variation in number it has given. And this is where this tool fails, because cyclicality, it takes the average worst case growth rate, average worst case margin. So it becomes you see the delta or the variation between the best case and worst case becomes very difficult if you don't understand the stock in detail. I would take on a conservative side the worst case revenue growth rate for Aarti Industries, and the margins are expanding slowly. We could see over the last 3 quarters, the margins from a low of 12 has gone to 14, and it has been between 15 and 14 and 17. It's only in this during September 24 and December 24, which is pulling down the margin. So here I would rather put a margin of 15. You can see the price has increased. So listen to the con call. You have to be much more, you should know much more in detail, understand the industry when it comes to the commodity prices, the industry when it comes to cyclical sector like chemicals. So have that caveat in your mind. Again, when it comes to cash flow, here the cash flow are negative. So whenever, because they are investing a lot in capex, right? So whenever that happens, I generally either use cash flow from operating activity, or I just take the profit after tax figures or the profit before tax. Look at the variability because of the margin, right? For the best case and the worst case. I would try using both profit after tax, which is 331, and also the cash flow from operating figures, because this again is actually the cash that you realize, to get into a conclusion as to what growth rate is implied in the current price. So 331 is the current at, and with Aarti I would require at least 18 because it's cyclical and it carries higher risk. Terminal growth rate of 3, and if my holding period is 5, and since it's cyclical, I mean, I would give a PE of 20. It gives you an implied growth rate of 38%. I don't know, but then if look, this is again where you need to be a bit more judgmental. Like if you're going to use cash flow from operating, right, it's around 1,000 crores. And this is around 15 PE. Yeah. It has to grow at 15%. Doable? Yes, for you to realize 18% growth rate with the cash flow, it has to, grow at 15% year on year. So with cyclical industry, you know what the issues are. So understand the company, understand the drivers, the moving parts, and try to look at the variability, come to a conclusion, and take a call on it. Next, a distressed company. This tool doesn't work. I would not suggest. For example, Vodafone idea. You would not even know where to start with. You do the smart analyze. Yeah. So it throws you the number, it throws you the operating margin, it throws you this weird, I mean, there are going to be calculation errors here. So maybe you change the OPM to 40 and you see the EBIT margin changes immediately. So basically it is taking a lot of averages here and there. There are errors in the tool. It's not foolproof. Know what is driving what, extremely important. What PE can we give? I don't know, 10. Yeah, because it is negative, it is not giving a number. So yeah, until and unless, you go to a margin of 60, even then it is not giving a number because there are a lot of adjustments in cost that is happening. So this DCF doesn't, I mean, this 1 year forward, an idea where you have to get the 1 year forward idea of this doesn't work with distressed companies, especially which are in huge debt. If you would want to try, you can try with the cash flow from operations for the reverse DCF, but again I'll be very skeptical, but let's just try it. It's doing a 9,000 crores cash flow, and hopefully it continues doing at least that. And with Vodafone, risks are higher. You need to be compensated for higher risk. I would say 25 minimum. But then even if you want 20% return and terminal growth rate of 2%, yeah, and a 5 and 5 multiple, let's see. It has to grow at 2% is what it is showing. But yeah, which is definitely doable. They are growing even with this tough financial condition. They are growing at a minimum of 1-2%. So 20% return is what is doable. But yeah, not a recommendation, or just to give an idea how the tool works. Next, coming to banks and NBFC, this tool doesn't work at all. Don't even try it. It won't calculate in the first place. For example, let's take HDFC Bank. See, it doesn't even show you these numbers. So it doesn't work for, this tool is not built for banks and NBFC businesses. Yeah, and since we are microcap investor, let me take you through a microcap stock, a recent stock which have come, a very small company, Blue Pebble. So it's trading already at 16 PE, reasonably priced for a microcap. Basically, this company is into design, supply, and installation of interior workspaces, mostly in commercial space, and commercial sector is booming. I was analyzing this company. It's taking historical growth rate. I would be more comfortable at the worst case, because when I analyze, I think they would be, for the next year, they could grow at 30% is what I feel. And based on that, I would go with the worst case. Bit competitive industry. So this margin is what I am comfortable with, but management is doing a lot of things, and I would still be giving, I mean, not more than for PE. I mean, this is the best case, but the number based on these estimates, we are getting a value of 246. It's trading at what, 200? Yeah, it's trading at around 200. So around, like 20-25% upside is left based on these estimates, and considering the PE doesn't derate. These companies generally have, microcaps generally have very non-steady operating cash flows, and a lot of investment that goes in the initial phase of building the businesses. So here I would rather take either the PAT or profit before tax for calculating the reverse DCF. I would take 5.6 crores to be conservative. Better to be conservative always. So the 5 crores and microcap, you need to be compensated with much higher risk, 2%, and if your time frame is 5, and I would go with the terminal multiple of 10. So basically what it says is, for you to realize a 25% return, the company has to grow at 27% for the next 5 years. And if you are taking future, profit or future profit before tax, then these numbers can change a lot. So even, like if you take 7 or 8, you see the growth rate coming lower. And if your return expectations are lower, again, this growth rate grows. If you're taking terminal growth rate of 5, this falls down again. So if your holding period is longer, again, falls down if it is P. So it's a good tool to give you an overall idea, to come to a judgment to where the current price is, whether it is justifiable. Always try to be very conservative when keying in the numbers. So that's all from my side. Do try it out. Really useful to give you a very quick intuitive idea of where the company stands. Closing thoughts: it uses its own formula. It doesn't use its judgment. Please use your judgment, read through con call, understand the business thoroughly before you key in the numbers, the drivers, etc. It's not suitable for banks, NBFC. I would rather use it for companies that has less of cyclicality. As shown, it can throw inaccurate data, so always double check the information, especially where we are calculating the bull case and the bear case. It can create a false sense of comfort. Don't use this as a tool for you to skip your research. Do your research. It is just a validation tool, nothing else. Finally, this is a third-party tool. It's not built by Screener, but a lot of people are using it. I'm also using it. Treat it like a calculator, but have your own judgment. And finally, support us. We are giving you a lot of such useful information that would help you when it comes to your investment journey. We are focused on microcap. Also, as suggested in the starting of the video, try out our 20-factor framework for all the companies that are there in your portfolio. Check out the video, see how to do it. You would be amazed by the clarity and the process. It gives you a structure, basically. Looking forward to give you such insightful tips in the future. So do support and follow us. See you in the next video. Thank you.